Okay, you're going to love this. Which pension is better for you? How are you going to retire richer? So I did the maths for you. I'm going to zoom in. Okay, let's assume you're 40 at the moment, but I will do other ages in other videos, so like and follow for more. And you hope to retire at 65 and your current income is £55,000. Okay. Different countries, this would of course not apply to. This is for the UK. Workplace, your pension is workplace, all right? Now, your pension pot, let's say at that age is 350,000. As I said, I will work with other figures. Your pension contribution is 5% of your salary and your employer's contribution is 3%. In retirement, let's say you want to have £100,000. Now, this is where it gets worrying, and I'm going to compare workplace with a personal pension, and it might just scare you. Your pension could give you this much each year, 77,472, well short of your 100K a year you want. Remember, we said your income is 55,000 and these are your contributions. However, what are the assumptions? Let's just look at those, and then I'm going to compare it with if you did not a workplace pension, but a personal one, i.e. a SIP. All outputs in the calculator are estimates, of course, based on the following assumptions. This is your only pension, other than the state pension. Your employee or personal pension contributions include only basic rate tax relief. Higher rate taxpayers claim more via self-assessment. Your pension fund grows at a steady 4%. That's not guaranteed. You use the whole pension pot to set up a drawdown scheme, okay, to get your 100,000 target from retirement. You take a fixed income from your drawdown scheme starting at your chosen retirement age and lasting until age 88. All right, your drawdown fund achieves a steady growth of 4%. So you're drawing capital and obviously the income's growing with the depleted amount of capital left in there. Estimated pension income does not include any state pension, etc., and ignores income tax because that can obviously change if any is due. Now, what would happen if, again, you're 40, and I'll do different examples, so do follow and like for more. The age you hope to retire is 65, but this is now a personal pension, okay? It is now a personal pension we're going to go into. Your current income's the same, 55,000. So a personal pension means a SIP, self-invested personal pension. Your pension pot is currently, again, we'll assume exactly the same, 350,000. You're contributing £1,000 per month. This is per month, okay? Into that from your income of 55,000. In retirement, again, you're hoping for 100,000 to be left with. Well, your pension could give you 105,000. In fact, you're over-contributing. You could contribute less. What were the assumptions, though? Similar assumptions. Only pension, excluding state. Your employee or personal pension contributions include only basic rate tax relief, same as the other one. Your pension fund grows 4%, same as the other one. You use the whole pension pot to set up a drawdown scheme, like the other one. You take a fixed income, like the other one, until age 88. Drawdown fund achieves steady growth of 4%. Again, estimated pension income does not include any state pension and everything else. So why the massive big difference? Well, it actually comes down to your contributions, and this is where people get things wrong. There's a couple of important lessons here. Firstly, it's not either or. You don't have to have either workplace or a SIP. The second thing is, of course, with a SIP, you might do better than 4%. That's why I have a SIP, because I know by buying Microsoft and Amazon and Apple, I'm going to outperform the workplace pension I could have with a pension fund manager, even though there's employer contributions at 3%. Because I know, for instance, this year, the kind of returns I got, but I know I've got that ability to pick those stocks. So a self-invested personal pension might not be for everyone. So it's not an easy choice to make, and you should make sure you research all of this, of course. But really, the bottom line becomes, you should be, if you can afford to, maximizing how much you use in a SIP outside of your workplace pension, rather than just either or, so that you get a better retirement. Now, you might say, forget that, I just want to sell the world today and I don't care about a better retirement, in which case that's fine. But really, the bottom line lesson for me is, if you've got the ability and confidence, then have a SIP and pick those stocks yourself. If you don't, then try and save more if you can outside your workplace pension contributions in a SIP, because you can have both side by side. And at the moment, as at the time I'm at the date of speaking, £60,000 is the total you can have in your pension contributions in a year maximum, but there's limits relating to, you know, your income. Anyway, I've given it in very outline terms. There's lots of caveats. But I hope that was a little bit more explanation that could help people. And I will do more of these videos with different examples on the calculations and so on. Have a look at alpeshpatel.com/links. If you're in the minority of 10% who would like to be handheld on, well, okay, how do you go about picking stocks in a SIP potentially? How do you learn that? So have a look at that as well. Thank you very much. Hope you found that interesting.
This I did in the 5 years to 2020. Now we're 5 years on. And guess what? That gap still exists. This is why the Americans get rich over the preceding 5 years. And I want to show this one because I want to show you, well, what's happened 5 years later? Same bloody thing.
So here's what you should do next. For a ton of free resources to improve your pension, go to alpeshpatel.com/links. You'll find free books that I've written about investing published by the Financial Times. In there, you'll find the offer of a free pension review, as well as free course materials as part of my campaign for 1 million to teach 1 million people how to add an extra 1 million to their pensions across their lifetimes. That's 1 trillion. That's my ambition. It's completely free. All of that material, alpeshpatel.com/links. That's what you should do next. Thank you.
Boredom and panic. Those are the two reasons you're going to mess up a good investment. Out of 10,000 securities listed on the London Stock Exchange and the New York Stock Exchange and NASDAQ, which can be in your SIP or ISA, there's only about 200 worth considering.
So here's what you should do next. For a ton of free resources to improve your pension, go to alpeshpatel.com/links. You'll find free books that I've written about investing published by the Financial Times. In there, you'll find the offer of a free pension review, as well as free course materials as part of my campaign for 1 million to teach 1 million people how to add an extra 1 million to their pensions across their lifetimes. That's 1 trillion. That's my ambition. It's completely free. All of that material, alpeshpatel.com/links. That's what you should do next. Thank you. Is ChatGPT going to pick stocks better than a fund manager? Well, let's have a look and see what happens with a little experiment. Let's go to ChatGPT-4, which you can see over here. Let's feed it some data. Okay, so I've taken a ton of data in actual fact over here. Now it can't absorb the data across all these tables and 10,000 stocks, so we're going to have to do it in chunks. And the way we're going to do it is, and the great thing about this is it can read all of this rather well. We can crud across, we can actually go right across even more, but I'm just going to show you this for illustrative purposes. We're going to cut, we're going to copy, we're going to put that in, we're going to then put it in there, and then we're going to start asking it questions, okay? And those questions could be anything such as, imagine you are Warren Buffett, and, well, the love child of Warren Buffett and Eugene Fama, the Nobel Prize-winning economist, and Daniel Kahneman. Analyze this data, and with your greatest powers of forecasting and analysis, and throw in there that you also work at Goldman Sachs, JP Morgan, and Morgan Stanley simultaneously, which stocks look like they're most likely to perform the best over the next 12 months. When we finish the experiment, I'll let you know how it gets along, because I've got to put that across quite a few pieces of data. So future videos coming, you better like and follow for more of that. Could get interesting. In my experience, when it comes to pensions and stock market investment and portfolio growth, there are several things all people actually want. They want to know what to do in simple terms and easy to follow processes, because not all approaches are suitable for everybody. Some people want to be very hands-on, others just want to be given a flow chart to follow. They want the data and information at their fingertips. They don't want to be sifting through tons of it. They don't want to be overwhelmed with lots of information so that they're confused and they don't know where to look because they don't have much time, of course. They want to smell the roses, spend time with their family. And they want the education to be simple and bite-sized, and effectively want one-to-one tutorials. So for that, I stole the Oxford University model, where I teach people one-to-one. I also give them, of course, online education and copies for free of my books. But it's the one-to-one education combined with the data and the information which became a game changer. Then we decided, well, we're not going to charge them fees every day, every week, every month, ongoing forever. We're going to let them handle their own money through our education. So they don't even need to be paying us like they would an IFA based on performance or assets under management or anything like that. We then decided, well, why not make 99% of it all free? So we did that as well. Have a look at the link in the bio or go to campaignforamillion.com. Our job is to educate, to inform, and leave you in control of the investing part and save you a ton of time as well. That's the goal. I think we're doing rather good at that goal. Thank you. When I set up the hedge fund in 2004, I used to look enviously at these kind of banks and think, just to look at the amount of money that they have got, that they manage. Anyway, many, many years, 30 odd years later, or 20 years later, I now even have my own t-shirt to teach people how to do it. And I really stole the idea, I guess, from Ray Dalio, the founder of the world's largest hedge fund, who on TikTok gives words of wisdom. So, you know, if he does, why shouldn't I? So what I'm going to do today is I'm going to show you what I wouldn't normally do. This would normally be just for Great Investments Program clients only. But I'm going to give you a little bit of a sneak preview of some of the most recent buy recommendations from some of the biggest wealth managers. And then what we're going to do is we're going to look at these and we're going to look to see which ones, even though they don't meet my strict Great Investments Program criteria, which are very strict, a bit like Warren Buffett's criteria, incredibly strict, and most companies don't meet it. We're going to look, nevertheless, if one of the wealth managers given a buy upgrade in the past week or a buy confirmation, assuming they've got over 10 billion in management, which all of those do, at least a 40% reasonable target in the next 12 months, and you can see for yourself, I'll show it, you make your own mind up, but I'll show you what I think is reasonable. And I'll specify the exit such that the reward level, i.e. the 40% or more, in some of them they've got 100% reward, is multiples to the downside where you'd exit. Now, as I said, they don't strictly meet the Great Investments Program criteria, but it's a new thing we started doing. So I'm going to, for the first time ever and only time, I'm going to show you some of them. Otherwise, it's going to be just for the program. I'm not going to show you all of them. People on the program, look at your private Telegram channel. You've just received them. So let's have a look. So Toll Brothers did have a 7, 8 or 9, but the momentum was too high. So it didn't fit into the normal criteria that I have of value, grow, income. However, 96% is a reasonable projection forward. It continues on that trend. Bank of America were the ones who gave it a buy, and you'd put the stop loss here. Now, you might say, forget you. I disagree with either that or that stop loss, or given momentum, or a whole host of other things. I disagree with Bank of America. When I had my Bloomberg TV show, this is exactly how we used to look at things and show things and project it. And somebody did say to me recently on an email, yes, I love it. So let's look at a few more, which normally is for clients only. I'm not going to show all of them. Clients get access to all of them. Clients of the Great Investments Program, please look at your private Telegram channel. The links are in the bio for the rest of you if you want to join. Okay, so that's 89 to the upside. That's the reasonable projection forward. It was Bank of America again who said buy on that one. It's a 7, 8 or 9. Okay, where would you put the stop? You'd probably put it there just to give yourself multiple upside to downside. Okay, once again, stop could either go there or here to give you multiple up to downside. And there's the projection forward on that. And it's a 12-month hold. Okay, so one of three things will happen. Either you'll make your 73%, or 12 months will be up and you won't, or 3, the fixed stop loss exit will have happened. I'm not going to go into all the hypotheticals that could happen between then. Okay, 61, this was again Bank of America's buy. You'd put your stop loss roughly about here. So multiple upside to downside, and that's fixed 12 months. Okay, 75 on there, your stop is here. App loving. I guess you could put your stop there. A bit tighter is here, which is a bit worrying, or there, and that's 160 to the upside. It also, more importantly, hitting our 7, 8, 9, or 10. It doesn't fit into my normal criteria of value, of the Great Investments Program, because the MACD is overbought. So please do treat all of these as high risk. They're not individual advice. Past performance is not a guarantee. Neither is a guarantee that just because Citigroup said it's a buy, that's going to happen. However, some of you are going to be very happy in 12 months. Applied Therapeutics, 325% would be the direction of growth. to the upside. Where's the stop loss? You could easily afford to put it here. Look at it. It's a tiny little penny stock. Please be careful. I know Citigroup said buy. It's a bit like that scene in Billions where my team will come up to you and they'll say, boss, I'm Axe, obviously, in this scene. Boss, we've got a idea for you. Citigroup are giving it a buy rating. That means they're going to put some money behind it, which will give it a bit of the nudge that we need. We're projecting it continuing forward for 12 months, gives it that. And you've got a tight stop loss. If we're wrong, we'll know very quickly and we won't have lost much money. Okay, fine. Right? Target 85 to the upside. Your stop is either here or it's here. Okay, and you might have get out half there and get out half if it drops to there. You're looking at that. Goldman Sachs gave it a buy. Most recently, T-Mobile, only 41. It was JP Morgan's buy, which caught our attention. Your stop losses here, 2 to 1, up to downside. Fine. Similar kind of thing. There you go. Now, as I said to my clients who at this point are crying, it's a one-off. I'm sharing some, not all, of the non-great investments program because none of these meet the criteria. Non-special situations. The special situation ones, which I have more confidence in, they're only going to be going to the clients on the private Telegram channel. This is non-special situation. It's outside the great investments program, but I'm showing people how we do things. And the new thing that we launched this month for clients, or this week, JP Morgan gave that back, which is this. Stop losses down there. Okay. I hope everybody learnt something. I hope it was fruitful and interesting. And there's the URL. Who wears it on a t-shirt? So I want to give a special thanks to Michael Bloomberg, because it was my time at Bloomberg Television, which I guess finessed the presenting aspect of it and keeping it sharp, keeping it pointed, keeping it valuable content. And he was great as a business person and seeing business at Bloomberg TV up close that way. And the second person I guess I want to thank is Ray Dalio for being on TikTok and, founder of the world's largest hedge fund, but on TikTok sharing snippets of information news, which makes people like me think, wow, I want to do that. Why would I not do what Ray Dalio does? Just copy the billionaires. Thank you all very much. I hope you found it useful. Have a look at the links in the bio. Do like, follow, and all the rest of it. Thank you very much.
Pension problems. As a hedge fund manager, I have a whole team to help me analyze people's pensions. If you want a free pension review, we're more than happy to go through it, because there is a major pensions problem in Britain, in the United States, in South Africa, in Australia, in all the Western countries I've come across, which is underperformance, low growth. And the major factors behind this are that the IFAs and wealth managers don't listen to what the client want. And so they deliver what the IFA wants to give them, which is usually just slightly above bank interest, so that they can manage those expectations of their clients lower. And when they exceed that low bar, they can say, I told you I could do this. It also means when there's less growth, that the clients tend to leave them alone, because the clients just assume, well, it's a bit better than the bank, so it's okay. Whereas if you try and get superior growth, tracking an index, for instance, you might fail by more than 1 or 2 percentage points in a year. Well, you're supposed to invest long term anyway, and the client might pull their money. The job of the IFA is to try and keep your money for as long as possible. A bit like a vampire putting you in on a drip. They just want to suck the blood for as long as they can. They don't want to actually kill you. And blood-sucking vampires is what IFAs and fund managers, in my experience, are. And I'm speaking as a hedge fund manager. I know this industry. Can your IFA say that? Can your IFA say they've won competitions in the Financial Times and on Bloomberg TV to forecast the markets? They've written 18 books published by the Financial Times. Can they say they've lectured? Sorry to sound arrogant, lectured on behavioral finance and exactly this point at Oxford University as a visiting fellow in business there. Now, the reason I make these points of credential is because too often people just sleepwalk into a wealth manager or an IFA or a fund manager who sit there having passed their multiple choice exams and spewing out the same old nonsense. Now, I know they do other things. They've told me, the IFA said, well, we don't just pick bad funds which underperform. We have other jobs like foot rubs and back massages for clients. I understand you've got other jobs as well. But until they get the right credentials and they actually know what the hell they're talking about, and no, don't ask me, is there a good one? Never met one yet. My life's mission has been to teach people to do it themselves. because they can. That's why SIPs and ISAs were created in the UK and 401ks and Roth IRAs in the US, because they want you to have the freedom to be able to do it yourself. Okay, it's not that complicated. If you can open a bank account online, you can open a SIP online. And as for selecting the right things, you're not forced into risky investments. There are low volatility funds, even index trackers, for God's sake. Even Warren Buffett says that, okay, that you could do and use instead. Have a look at the links around this video, or alpeshpatel.com/links. alpeshpatel.com/links. Set up a call with my team. They will for free analyze your pension, or you can fill it in a form and then have a call with them if you wish afterwards. They'll analyze it, send it back to you. I'll cast my eye over it as well. Okay, sorry if it sounds a bit arrogant. I apologize. I'm in the finance field for a start, but I'm bloody angry at all of these fund managers and wealth managers and all the rest of it. And so sometimes my anger can look like arrogance. It really isn't. Trust me, if you've been in finance long enough, you've had a few kickings. 2008, actually no, that wasn't too bad. 1987. Thank you.
The wealthy don't have better investments. They just have better information. Hedge funds and ultra-high net worth individuals don't rely on luck. They use specific metrics like the Sortino ratio, or CROCI, cash return on capital invested, used by Goldman Sachs Wealth Management, and cash flow momentum to filter stocks. In my Great Investments program, I break these down into plain English so anyone can learn how to invest with clarity and discipline. No gimmicks, no day trading, no get rich quick, but education. That's the key. If you're serious about understanding how smart investing actually works, start with my free course. Have a look at alpeshpatel.com/links. It's all for education purposes, and that means you're in control, because power comes from the transparency of having the data and the information, and from having the knowledge, knowing what to do with it. 99% of the people use my free resources. 1% who go to my sites used the paid version, where they have the one-to-one tutorials with me. I stole that idea from Oxford University, the one-to-one educational tutorials. But the 99% who use it for free, they love it as well. I'm happy for them. I want everybody to benefit. Have a look at the link in the bio. Have a look at alpeshpatel.com/links. Thank you. I look forward to hearing from you. So when it comes to setting up a hedge fund, what are the kinds of things that you should be aware of? A lot of people are interested in this right about now because of everything they're reading in the news. So I've made some notes and I want to cover some of these issues with you. First of all, strategy. Probably one of the most popular strategies and easiest and simplest is to go for an equity long short or a foreign exchange long short fund. Unless you've got some specific particular reason why you've got skills to be in another area. You're not going to be HFT most probably, which is high frequency trading. You're probably just going to be going for momentum or trend following. Some of the biggest and most popular funds are in this category: Winton, Aspect, AHL, Brevin Howard. So you're really, to some extent, going to be competing with those. And you might say, well, if I'm competing with those, I don't want to do that. I want to do, say, merger arbitrage. Well, again, don't worry. It's a crowded field there as well. So first and foremost, the strategy you're going to adopt, and that's really going to be down to your skill levels. Now, strategies, quite frankly, are to a penny. Go to Oxford University Maths department, as I always joke, and you'll find a lot of people who'll be able to help you with strategies. Capital raising is really difficult, and we'll come to that in a second. Secondly, your track record. Okay, now, of course, demo accounts are great, but seriously, nobody is going to give you money other than your mum if it's just purely based on a demo account. I'm afraid you're going to need to get capital to develop a track record, and at least 12 months of track record as well. And it can't be just one trade in 12 months. I'm afraid there's going to have to be some kind of minimum number which you've been trading over that period to showcase your strategy. And you'll have to explain your strategy in plain English, even if you've got clever algorithms behind it, because your investors will want to understand the basic thesis behind it and why it's so different to what other people are offering. So like I said, when it comes to track record, I'm afraid 12 months is the absolute minimum, and many funds and people won't give you money if it's even 5 years or 10 years. So 1 year is the bare minimum. The other thing to remember is how much capital you're trading with. Most will say, no, when you've got a few million, come back to me, because they know you won't actually get to that point. So that's important. Do it with live cash. Where are you going to get it from? I'm afraid it's going to be friends and family, like any other business. Of course it's going to be friends and family. That's how most people get money. It's always friends and family first. Nobody owes you a living. You're not entitled to get money. So that's the most important thing. And I'll come to performance in a second, because most people think the most important thing with a hedge fund is performance. I'm afraid it's not. You're handling other people's money. It's got to be in a safe infrastructure. So I'll address that in just 1 second. Now, the next thing, domicile. When I set up my first one in 2004, the fund itself was domiciled out of the Cayman Islands, even though our asset management company was British. Okay, and the reason we owned the fund domiciled out of the Caymans is not because we're trying to dodge tax or evade it or anything like that, as the press might wrongly make you believe, or lazy journalists will make you think. The simple reason is we have investors from all around the world, from different countries, who all have their own specific domestic tax rates. Some of those countries will have double tax treaties with, for instance, if we domiciled out of the UK with the United Kingdom, others might not. So they wanted funds domiciled out of a jurisdiction which itself charges zero tax, so they're only, when they're repatriating their money, paying tax in their home country. Us, as the what's called a general partner, the actual owner of the fund as well, the asset management company, the AMC, based out of the United Kingdom, it meant we weren't giving tax to any foreign government, certainly not the Cayman Island government. We were repatriating all our profits back to the United Kingdom. And as for profits, it's usually 2 and 20 your fund starts off with. 2% of assets under management, 20% of the profits you generate for the clients. Okay, and as I said, as they get repatriated to the United Kingdom, we paid all our tax in the UK, because as well as the company being headquartered here, the asset management company, so was I as the shareholder, the major shareholder. Next step, setup. How are you going to go about it? Well, you're going to have to meet a lot of different people. The lawyers we chose for the UK asset management company happened to be Simmons & Simmons, because they were the number one. And this is where it's really important to make sure the professional service providers you use signal that you're a quality outfit. So we went with the number one law firm in the UK for hedge funds, which was Simmons & Simmons. For the Cayman Islands, it was a law firm called Walker's. Why? Well, because they were the number one for Cayman Island hedge fund setups of the nature and type we wanted. Accountants. Now, these are equally important. I'd probably say a little bit less important than the lawyers, and I'll tell you why. Because more important than the accountants is your auditors. Our auditors were PricewaterhouseCoopers. By the way, our regulatory body was the Financial Services Authority out of the United Kingdom, and of course the Cayman Monetary Authority as well. But most important is the Financial Services Authority. Why? Because it's a credible regulator, and the rest of the world wants to see, when you're raising capital, that you've gone with a credible regulator. Okay, custodian and custodian bank and administrator. Now, administrators, incredibly important. Okay, they're the ones who will work out how much returns you're actually making. And you might think, well, why can't I just make that out and tell my investors how much I've made? Nobody trusts you. That's why. You always need an administrator to make sure everything, all the trades are tallied up. So whatever trades you've placed through a prime broker, and we started off in 2004, our prime broker was, wait for it, Bear Stearns. So guess what? 2008 comes, we've got to find a new prime broker. Our assets are all in safe custody with our bankers, so there wasn't an issue there, but the prime broker is used. Think of a prime broker as an institutional quality broker. We would have to have our board meetings offshore because the fund was domiciled offshore. And if we didn't want it domiciled in the UK, I would have to fly to New York to the offices of Bear Stearns to have our board meetings for our Cayman domicile fund. Why not in the Cayman Islands? Well, it killed two birds with one stone to go to New York. There's not much happening in the Cayman Islands other than a nice beach. So I would fly out to New York. Your board of directors on your fund, by the way, will have to be majority offshore for the domicile of the fund to be offshore. And remember, the domicile of the fund is offshore, not just to benefit you, so all the profits are repatriated 100% back to your country where the asset management company is, in my case, the United Kingdom, and 100% tax paid here, but also, as I said, for the benefit of your investors, you want it domiciled offshore, as I said, in this case, in the Cayman Islands. Okay, and my board of directors were also domiciled offshore as well. So we've got administrators, custodians, prime brokers. You're going to have to meet quite a few. Many won't accept you if you've only got relatively little sums of capital under management. Auditors, accountants, lawyers. Now, lawyers and accountants and auditors will happily accept you as long as you can pay their fees. The cost of those fees will be amortized or spread over about 4 years on the performance of the fund. So if the fund, whatever it performs, each month a proportion of that will be spread out in terms of legal fees. The lawyers you'll be paying up front, I'm afraid, but the fees will be spread out for the purpose of the accounts to work out what your performance ratio is. Now, the good news of that is that you're not paying it out of your own pocket. The bad news is that your clients are paying it and it hits their performance. So be warned on that. It can make what otherwise would have been good performance look pretty poor. The alternative around that is you as shareholders pay it and not charge it to the fund. The normal practice is to charge it to the fund. This is also why you need a lot of capital to start off with, so that the costs are a very tiny proportion of your monthly performance and therefore does not damage your performance figures, which will be essential to raise more capital. And when I'm on the subject, we'd have a saying, we would only ever raise on an up month. If we had a down month, we wouldn't go capital raising because it looked bad. And of course you're going to have down months. And you're going to, of course, have up months. Those, what you've got to be ready for to go out marketing. Coming to marketing and raising capital. Prime brokers will have a capital raising department. They're not going to help you. You're a startup. Unless you're coming in with about $1 billion, they're not going to help you on capital raising. But what Bear Stearns did for us is give us that entire spreadsheet for capital raising. That included every single global, well, non-US, global non-US high net worth family office sovereign wealth fund, including the name of the individuals we should approach, their email addresses. I've still got that spreadsheet. It's invaluable. Okay, no, I'm not going to share it. That's what really helped us on the capital raising cap intro. Whilst their cap intro department at Bear Stearns wouldn't go out and make the introduction themselves, they're too busy, they're too big for us. At least we got that spreadsheet. And so try and get your hands on that. They'll all promise before you become a client to give you cap intro. They won't do it because you're too small. Okay, and that's critical because guess what? The scarce resource is not winning strategies. The scarce resource is the ability to raise capital. Our secret sauce, Bear Stearns' cap intro Excel spreadsheet. And to this day, I've got those connections. It helped us get the meeting with, for instance, Lakshmi Mittal's family office. Okay, at his offices in Berkeley Square in London. These things are critical. Family offices of other multi-billionaires. Without that list, we couldn't have done it. Of course, what was critical is some warm introductions and the chance meetings with people that you have. For instance, one of my meetings was I was having dinner. I happened to be a visiting fellow at Corpus Christi College, Oxford. They asked me to host a dinner for a billionaire financier. Guess what? I pitched him over dinner, and he arranged for the head of his family office to come to my offices to look through my fund. That was another critical, important factor, those networks and connections. I wasn't born with a silver spoon in my mouth, so I had to use every single way I could in order to get those access and those funds. So what else? What else is there? Well, what we do for marketing is this. Every weekend, we do what's called an objection clinic, where I would pitch the fund, but we'd write down all the objections the other person might have, such as, why should I give it to you and not Goldman Sachs? You're young, it's a first-time fund, you haven't got a lot of capital under management, your track record's not long enough. Why should I invest in this sector, this segment anyway? What assurances are there you'll perform the year after? All of these objection clinics had to be handled. What's your credentials? Now, again, I'd built up my credentials over a number of years. I'd written 18 books on investing. I'd won competitions on Bloomberg, on Channel 4, and the Financial Times. All of these things are incredibly, incredibly important when you're raising a fund because, again, the issue is, why should I give you my money? Why should I give you my money? Okay, so those people who think, oh, I'll just do a couple of trades and somebody owes me a living, doesn't work like that. Couldn't care less. I get 100 approaches a week probably of people saying, oh, I've generated this trade, I've generated that. doesn't matter. And again, I'll come to in performance terms what does matter. Then comes size of fund. The bigger the better, of course, but guess what? You're a startup, you don't have great connections, you won't have a big fund. That's going to be a problem for a lot of investors. They're not allowed to invest in a fund where their investment is more than, say, 5% of the total assets under management. So you've got a cap there. It's a chicken and egg. Nobody owes you a living, though, I'm afraid. So they can't just give you the capital because you say, hey, look, I'm a really nice bloke, help me get a leg up. It doesn't work like that, I'm afraid. And so networks really do determine your net worth. Networks determine your net worth. You're going to have to build better networks, really better networks. Okay, how do you do that? You're going to have to get onto boards, you're going to have to volunteer for things, you have to turn up at events, you're going to have to be on a variety of different councils, and in order to get those, you're going to have some natural abilities and skills as well. Not easy, is it? Neither success, otherwise we'd all be billionaires. So that gives you an idea in terms of size, longevity. I've said marketing, capital intro, setup, domicile, track record, strategy. Let me close with this. The most important factors that an investor looks for before they become an LP or limited partner in a hedge fund will be Sortino ratio and alpha. Alpha is the ability to outperform the market. The Sortino ratio is consistency of mean returns. So it's not just the returns you generate, but also how consistent you generate them. The Sortino is not the Sharpe, it's actually better than the Sharpe ratio. The Sortino says upside volatility is good, i.e. if you overachieve your average, it's good, but if you underachieve it, you should be punished for it. And that's what it looks at. And it basically essentially is saying what's the standard deviation around the mean. So Sortino you'll have to work out for your fund. Alpesh, how do I do this? If you need to ask, you're not ready to launch. Okay, if you need to ask, you're not ready to launch. Alpha outperforms the market. The next most important thing is correlation. You see, investors will already have invested in a whole bunch of assets. They want to get into something which isn't highly correlated to what they've already invested in. Okay, so the less correlated you are, for instance, to the S&P, on the number of months the S&P rises, how often do you also rise? Because that would suggest you're correlated. But when it rises, how often do you fall? Well, that's not good. That means you're not even going up when the market goes up. Most important, when the S&P falls, and taking that as an equity long-short benchmark, how often do you rise? That's going to be important. And not just for the S&P, that's oversimplistic, but correlation to other asset classes as well is very important, because all your investors will know the more uncorrelated assets in a portfolio, their portfolio, the more likely they are over the long term to get wealthy. Or put another way, they're at the efficient frontier of investment. Don't know what the efficient frontier is? You should not be launching a hedge fund. And the final question when it comes to launching the fund, why should they give their money to you when they could give it to Goldman Sachs? You've got to be able to answer that as well. For us, it was because we had data to show that younger managers tend to outperform in the first couple of years before they become fat and complacent and don't have hunger anymore. And that was important at the time we were capital raising, because some of our big institutional investors said, yes, we want young new managers. Okay, so we got lucky. Yeah, guess what? It's a business. Luck is an important factor in business. It is an important factor in business, being at the right place, the right time. All of these things are important. By the way, would I launch a hedge fund today? Would I do it now? No. I'd probably set up a fintech company in software. I'm not the only one. A chap called Jeff Bezos, who used to work at D.E. Shaw, the hedge fund D.E. Shaw, left it to set up a software company called Amazon. And he's the one who became a trillionaire, not D.E. Shaw. So what would I do today? Financial technology and software. But heck, the hedge fund industry, it's allowed me to get to where I am, and I'm most grateful. Hopefully you found that all helpful. Don't forget to like, subscribe, all those things people do in social media, and I'll give you a heck of a lot more insights as well. Follow me on LinkedIn, ask me any other questions you've got, and we'll go through some of those if you need those pieces of assistance. And no, you can't have the CAP intro Excel spreadsheet. And the reason for that is not because I'm being unhelpful, but because guess what? I had to do it the hard way. There has got to be a limit to how much help you give people, doesn't there? I didn't grow up with a silver spoon in my mouth, but the CAP intro Excel spreadsheet, That's actually my intellectual property, my proprietary IP I'm going to keep hold of, if you don't mind. Thank you. Stop looking for the right IFA or wealth manager. Okay, that headline, 9 in 10 pension funds underperform FTSE All-Share Tracker, tells you that all that's going to happen is every single one you go to is going to give you the same set of selections. So what's going wrong with pensions, whether you're a professional or a business owner? What is going wrong and why is it going wrong? Well, first of all, institutionally, there's a conflict of interest. They can't, in a year like 2022, tell you to go into cash because they won't get paid. And in years where the market's falling, cash is the only alternative because hardly anything's going up unless you want to see your money being burnt in front of you. You might enjoy that. Okay. Get educated, get informed. I have a ton of free resources. As a hedge fund manager, as somebody who's written 200 columns in the Financial Times, I'm more than happy to share those for free. There's a link on the screen. My team and I will, for free, it's our pro bono work for society, review your pension. We'll give you a free copy of my Macmillan published book. It's one of 17 others that I've also written, reviewed by the Financial Times and by Bloomberg and by the BBC, amongst others, and hedge fund managers as well. Okay, let's get informed, get educated, take action. It is your pension, and for God's sake, I mean, of course, I appreciate you don't read Pensions Age. Who the hell does? People like me. You will see, and this is not new, the performance of pensions in Britain is piss poor. Okay, we've been given these wonderful tax-free wrappers, ISAs, SIPs, and we're not making money in them. Now, I'm not a conspiracy theorist, but it almost makes you think that if you made the kind of money that the Americans make in their pensions, because they, of course, track the NASDAQ or the S&P, which you would be able to do in the UK as well, then the 55% the NASDAQ went up in 2023, or the 25 odd percent it went up in 2024, might lead to a lot of people retiring early. Maybe the employers just want to put you into poor funds, or the IFAs and the wealth managers, so they can milk you longer for fees. I'm starting to get a bit conspiratorial. When I did my Bloomberg TV show on Tuesdays and Wednesdays, I would talk about exactly this issue, and I've been surprised to think that 25 years later, I'm still talking about the same stuff that I mentioned. I bring up on my BBC newspaper review whenever I can as well. Anyway, if you'd like a free pension review, if you're in that category of a professional or a business owner, for instance, or actually somebody who's approaching retirement or already retired and worried about growth, then do feel free to get in touch. We will put those resources your way. Thank you. North American stocks for your pension. Let's have a look at the Scottish Widows North American Pension Series 3, should we? Okay, now, I like the fact that they've got a weighting greater than 5% in these. That's good, but they've only done it for the top 3. After that, they're just spraying and praying. Okay, and that's a problem. It's a problem which is common with these. It'll mean guaranteed you will be underperforming given what they're investing in. Don't compare it to a bank interest account. Look at what they've invested in. Apple, Nvidia. So how come they're not up? That's a lot of NASDAQ stocks. How come they're not up in the last 12 months? They're 33%. NASDAQ's up because they've put too little money in other things, because they spray and pray, because they don't have the courage of their convictions, because they're too afraid of losing your accounts. Also, when the market falls, as for instance, Meta 2022 dropped 70% and lost 7 years of gains, the danger is these can't go into cash because they can't. These funds can't. And you end up, and it's the same old story I keep saying, you end up getting stuffed. So you feel happy for lots of years, and then all of a sudden you realize, bloody hell, I'm buggered. Okay, have a look at my links in the bio. Have a look at alpeshpatel.com/links if you would like to learn more. Thank you. Please check your pensions. Ever since I started writing for the Financial Times 23 years ago, I've been warning about this one problem with people's pensions, and it's become very clear from an email that I received just very recently. And it goes on to say, "Good morning, Alpesh. Very interesting what you're doing. This is the bit which caught my attention. Okay. Recently, I have been able to check my own pension provided by Legal & General. This was provided by my employer. The information was shocking, 20% growth between 2012 and 2022. As you can imagine, I have now taken steps to remove this and control the funds myself. Currently, I can get 5% interest at least. Now, what's shocking about this is the 20% growth over that time frame, and it's legal and general, and it's employer provided. You'd think the employer would give more of a damn, wouldn't you? I tell you why it's all shocking and very worrying. The reason is this. Over the last 10 years, the Nasdaq's up 382%, and you might not have met that market target, and this is open to all UK pensioners, by the way. The S&P 500's up 166%, the Dow's up 134%, the UK markets are up, even they're up more than what this individual got. So I did some simple maths, and this is the maths. Based on the growth percentages provided, okay, the Nasdaq would have seen this individual's £100,000 become £482,000. Big difference in your pension pot if it went from 100 to 482. If he just tracked the S&P, I'm not about outperforming the market or picking stocks. Hopefully you could have cherry-picked those and done even better, but let's just assume not. 100,000 would at least have 266,000 in his pension pot by now. Satisfactory. If you just even track the UK market broadly, should be 124,000. Okay, that's only £24,000 up on his 100,000 originally. He didn't even get that. I mean, it is embarrassing how shockingly bad the UK pension system is. People don't check their pensions, they don't ask their employers, and this is one key reason why really you should, and urgently, as a matter of some emergency. And if you want to know who I am, well, I've been banging on about this on BBC. I've written about it in my books, this very same problem of why pension fund managers underperform, and you can follow me on LinkedIn and elsewhere. Have a look at those links if you'd like some free resources as well on how to do things better yourself. Nobody cares about your money as much as you do. Stop giving it to fund managers. Learn how to do it yourself, and I have to at least ask the right questions. Thank you. Your workplace pension is like a hotel minibar, expensive but low value, and nobody tells you what's inside anyway. Over 90% of UK savers are stuck in default pension funds. They're easy to ignore, but that's exactly the problem. Most underperform global markets. They charge you fees even when they fail to deliver, and no one tells you about the real risks or hidden costs. You wouldn't eat from a minibar without checking the price first. So why risk it with your life savings? You've got to ask yourself that. What if a simple 5-minute check could save you thousands? Well, that's where I come in, and it's free. My free course shows you exactly how to assess your fund's performance, understand your real risk-adjusted returns, and take control without being a trader or hiring an expensive advisor. Go to the links in the bio or alpeshpatel.com/links, and it's got that 5-minute checklist in there. Plus, you can speak to one of the team if you wish as well in person over the phone. Thank you. I hope you liked watching that video. The best thing you can do now is follow, like, maybe even save the video, but have a look at the link in the bio. Have a look at alpeshpatel.com/links for free investment books, education, mentoring, information about pensions, information about why pensions are not growing as much as they should, what you can do about it, free educational course, a whole bunch of free resources to improve investments and pensions more broadly, wherever you are in the world. The links in the bio can also be found at alpeshpatel.com/links as well. Thank you. Want a free copy of that? The link is in the bio. Every month you wait to take control of your investments is another month of paying fees on underperformance. Let's say you've got £200,000 in your pension. Even a modest 2% improvement in annual returns compounded could be worth tens of thousands more over 10 years. My program doesn't promise returns, doesn't guarantee them, because you can't guarantee the future. What it gives you is control. You learn the exact steps I've taught for over 20 years from institutional investors to private clients on performance and common traps with investing. If you're ready to stop guessing and start understanding instead, book a free call or access the training at alpeshpatel.com/links. This isn't financial advice. Results can vary in the future, of course, to what they've been in the past. And this education and the data it gives is the real power. Stop outsourcing it at expensive fees to IFAs, wealth managers, St. James's Place, all of those places where the complaints are hefty. Instead, take control. And if you're in the 1% who want that personalized one-to-one education with me and the data that I use, so education and data, that's great. That's through that link as well. But if you're in the 99% who want to absorb all the free resources, I'm happy with that as well. And there's a ton of free resources, from books to online courses to free market updates, all through that link in the bio. I look forward to hearing from you. Thank you.
One of you sent me your pension to review. One of the major holdings is Standard Life North American Equity Pension, which in and of itself initially would sound good. North American equity, yeah, why wouldn't everybody want that? There's two problems with it, which first and obviously come to mind. First of all, from January 2022 to January 2024, so 2 whole years, it delivered pretty much a 0% return. It didn't beat its benchmark either, but forget that. 0% return. Now, why is that a problem? You might say, well, yeah, maybe the markets didn't do too well. Well, you're right. In 2022, you had a negative year. But I'm talking about 2 straight years here. 2023, the NASDAQ was up 55%. Remember, this is a North American fund, right, that I'm looking at. And the S&P was up something like 30%. 0% for 2 whole years. You might say, well, maybe it was just recouping the losses from 2022. Well, here's the problem. First of all, it wasn't. Secondly, 2022, why didn't they just tell you to hold cash? Because they'd never tell you to do that. So you're just supposed to suffer those big drops and losses. So that doesn't help either. Okay, well, how's it done last year? You could have just had an index tracker. I mean, you're wasting your bloody time. First of all, it didn't beat the benchmark last year. Secondly, you could have had an index tracker. S&P 500 would have been good. I mean, this is North American. And you might think, well, no, North American's more than just the United States, contrary to what the president of the US might think. Well, actually, no, because I'm looking at its top 10 holdings, and here's the problem. You could just have bought them. You might say, well, no, but they might want to switch those around here and there. Yeah, which would cost you money, fees in paying the manager, and transaction fees. Could have just held them. Okay, what are they? What are their largest holdings? And here's another problem why they're underperforming against a benchmark. They've got, after holding number 3, after their third holding, they've got less than 5% in all the others. Why is that a problem? Well, if they're an expert, why do they have 1% in their 10th largest holding, which is JP Morgan? I own JP Morgan. I've got more than 1% in it, because I've got more confidence in my abilities. Broadcom, they've only got 1.87%. Guess what? They've got a really good company there, which went up over 100%. But they put so little money in it, you didn't get any benefit out of it. Great, it moved your performance by 1.8%. Okay? Meta, 2%. Alphabet, 2%. Tesla, 3%. Alphabet, 3%. Amazon, 4%. If you've got 20 stocks, and you put equal amounts into each, you put 5% in each. If you put 40 stocks, you've got 2.5%. If you're risk averse, 40 stocks, 2.5% in each, risk averse but want to be in equities, will be adequate. But having less than 2.5% in each one just becomes a spray and pray exercise. So not being able to go into cash, spraying and praying, no wonder. I can dissect an X-ray like a surgeon, their poor performance. If you'd like to send me in your pension, feel free to do it. My team and I at the Hedge Fund will give you a detailed analysis. We'll also have a call with you if you wish. It's all free. It's all free. We'll have an analysis of it and show you where the weakness is. Now, you might say, well, what do you do? Well, I've just given you two solutions. One is you can just X-ray it and buy the things yourself. Secondly, have an index tracker. Have the benchmark tracker instead anyway. 3, learn to do it yourself if you wish. It is easy. I've written 18 books on investing. If you'd like a copy, send us your pension to review or details of it. You don't have to give us anything confidential. We'll send you back a PDF of one of my most recent books published by Macmillan. Okay, alpeshpatel.com/links, or go to campaignforamillion.com, my campaign to teach 1 million people how to add an extra million to their pensions across their lifetimes. Thank you very much. I look forward to hearing from you. Time to sack your IFA, and I'll tell you in very simple reasons why. This is the performance over the past year. The vast majority of companies have gone up, of course, but your wealth manager IFA, I guarantee you, will have underperformed whatever benchmark the funds that they gave your money to were targeting. Why? Well, because 90% of the time that's what happens. Eugene Fama got a Nobel Prize in economics for showing that. The second thing is, they will have put, if in any of these companies, and this is how they'll placate you, they'll say, oh, no, you don't want it on those risky American markets. Oh, and anyway, we put a little bit of money into the American markets. Here, there you go, your SIP and ISA's got a tiny little bit. Now, I'll tell you what the problem with all of that is. They'll have put a few percentage points, maybe 1%, into maybe an NVIDIA. Oh, it's all too risky. Now, if NVIDIA then goes up 87% or even 100%, guess what's going to happen? Your portfolio will barely have budged. So they put too little cash in. They spray and pray because they're so scared. But if they're supposed to be experts, should they not have the confidence to put maybe a little bit more in? Not the levels that a Warren Buffett puts into an individual company where he can own as much as 30%, 40% of Apple, but at least maybe 5%, 6%. They just won't do it. They might do it with 1 or 2 companies out of all their holdings. So you ask your IFA, why are you underperforming the various benchmarks? Why did you lose me so much money in 2022 and not tell me to hold cash? What's the Sortino? They'll look at you blankly. Okay. And also ask them, why are the various funds you've put me in sometimes investing in other funds from the same company? So fee layering, really bad. And also ask them, why are the funds that you've put me in holding so many stocks? That just means they've got so little money in any individual company that even if they're right, and they're the experts and they should be, they barely perform well. It's all very concerning. If you'd like a free pension review and see why your pension's underperforming, we'll do it for free. My hedge fund team and I'll do it for free. Go to alpeshpatel.com/links. We'll even have a call with you if you wish. Thank you very much.
If your pension provider hasn't called you in months, that's not wealth management. That's wealth neglect. According to the Financial Conduct Authority, over 91% of workplace pension savers are in default funds. Most of these have underperformed global markets and yet charge fees even when they lag behind. And yet most people never compare what they're getting versus what's possible. This program that I've created shows you how to assess fund performance, understand real risk-adjusted returns, and take control of your outcomes without needing to be a trader or a financial advisor. If you're ready to get educated and not sold to, and want a free copy of my book, want free courses, want free daily updates so you can understand how to grow your portfolio better, click the link in the bio or go to alpeshpatel.com/shares. We provide education, information, so you're more in control and you can make better informed financial decisions over your portfolio. Thank you. I look forward to hearing from you. Yeah, me again. When I recently did a video about whether you'd have enough money to retire on, what became shockingly clear is that even if some people could do the maths, they still didn't realize 2 major things on why they may well not have enough money to retire on. The first major thing they didn't realize is just how long people actually live. Many of them, through their maths, had assumed that they're not going to live as long as the actuarial tables suggest they will. That's the first problem. The second problem was that they thought they'd need a lot less money to live on. So they hadn't allowed for the fact of cost of living increases, inflationary increases, and what the data shows from places like the Office for National Statistics on how much money is actually needed. We tend to underestimate our expenditures and overestimate our incomes. So even when they got the amounts right, that they might even have $1 million by the time they're 60, they wrongly assume they won't need to withdraw too much and that they won't live too long. And of course, if they can live on a pittance and die the next year after retirement, they can blow the whole $1 million, of course, in a year. But in actual fact, people live a lot longer. So what is the major solution that I want to address and the problem I want to address? Well, have a look at the link in the bio, follow and like for more as well of this content. But the first lesson I want to give you is this. You can't increase your savings very often because people have just got a fixed amount of income if they're in work or elsewhere. You can't increase how many more years you can contribute because you are the age you are. Retirement is when you plan to have retirement. And you probably don't want to work longer. So the main thing that you're able to undertake is improving growth. And that's been the thing that people are most angry about with their pension providers, their IFAs and wealth managers, where they're promised around 5%. The way I'm trying to address that problem is giving people education and information. The education for them to know what to do with the information, the data I give them of individual stocks, of funds, so they can then more readily work out in a very easy way what they should and shouldn't be doing and why things are underperforming. If you level the playing field so people have got more knowledge, then they're less likely to be ripped off by high-charging financial advisors who are not delivering anything more than a 5%. One of the shocking things I learned from somebody who called me was that over the last 10 years, that individual had seen their pension grow by an amount less than the fees they'd paid the financial advisor. The financial advisor had earned more in fees than the pension had grown. And we're not talking about somebody in their 80s or 90s who had said, please keep this money safe. We're talking about somebody in their 40s and 50s. Have a look at the link in the bio if you want all that free education. It comes in the form of books, online courses. You can even reach out to us. Okay? Thank you. Pension shortfall for when you retire, whether you're a professional or business owner, this is typically the case. Let's take an example and I'll explain to you why. And it's not the reason why you think and what fund managers and wealth managers want you to think. Okay, so what I've done an example where let's say you say when you retire, you want to have £60,000 per annum. Now you might say, well, that's a lot. Fine, you could reduce it. We'll come to that later. And let's say you're about 50 years old for the moment and you want to retire by 62 and can play around with those numbers as well. And let's say you're doing your full pension contribution of 5,000 a month at the moment or 60,000 into your SIP currently. And your current pension savings are around £200,000. Well, you're going to be well off target because you want 60, you're going to end up with 30. You might as well, that's fine, I can live with 30. And let's have a look at what the problem is. And it's hidden in these online calculators, low down. Potential growth rate, medium. Guess what they put down as medium? 5%. Well, hang on. My bank pays me 4.5%. So why are they getting me medium at 5%? What's worse is high. High growth rate, according to them, is 8. My bank pays 4.5. Okay, let alone the NASDAQ was up 55% 2 years ago. Last year was up 25%. The S&P was up 25% last year, and the year before roughly 30%. They're talking to me about 8%. By the way, the long-term S&P 500 return over the last 10, 15 years in sterling terms is 15% per annum. They're talking to me 8%. So what they're trying to get you to do is increase your monthly contributions. Well, of course they are. They get more money if you do that. Delay your retirement. Of course they are. They get more money because you've got your money with them for longer and paying them fees for longer. Or just lower your ambitions and targets. And that's been the British disease. Just lower your eyesight. Don't be like the Americans. Well, actually, your SIP and ISA, you can be more like the Americans because certainly their pensions are more lucrative. I'll tell you how we do it, and what we think is a far better way of doing it is to actually put you in control. You have your own SIP and ISA with whichever provider you want. We'll give you the data to see out of 10,000 companies and 7,000 funds, which ones tick all our boxes and are all green. Out of 10,000 companies, about 200. Only 200 would meet the criteria of the kind of 40% projected growth and volatility below, say, 15%, which, if you don't know what that means, is pretty low volatility for an individual equity, let alone for funds where you can have under 10% volatility. That, we think, is a far better way where you're in control of your money, because nobody cares about it more than you do, with the tools needed. Okay, well, get in touch. I look forward to speaking to you. Thank you very much.
You don't have ISAs set up for your children. Junior ISAs, you've not set it up because you don't know where to start. You don't even know if they exist. Major problem, pain point. And if you do set one up online, how do you know to put how much money into it and where to put that money, what to invest in? Stocks, well, that could be risky. Funds, which ones? How do you decide? And if you do open one of those, you get so much information bombarded at you, you don't even know where to begin. If you want to have a look at a bunch of free resources I've put together as a hedge fund manager, as an author of 18 books, as a Financial Times columnist, as a Bloomberg TV presenter, if you want to see some free resources I've put together to help you, have a look at campaignforamillion.com, campaignforamillion.com, and that will help you along that journey, or just reach out to me and my team on alpeshpatel.com/links. Okay, and we'll direct you towards the free resources. We'll give you a free copy of one of my most recent investment books, published by Palgrave Macmillan and reviewed positively, I should say, by Bloomberg and the Financial Times, right? So get in touch. Thank you.
Why do 80% of traders, retail traders, lose money? As a hedge fund manager, let me tell you the main reasons. One, L plus L, losers add to losers. They'll add to their losing positions. Professionals, when it comes to trading, I'm not talking about investing, when it comes to trading, professionals don't do that unless it was part of some grand overall scheme strategy to begin with. Secondly, winners add to winners. We tend to add to our winning positions. Why? Well, it allows us to start small in case we get it wrong and we make a loss. We only lose small. But knowing that we're going to add to our winning positions when we've got some profits means we can start smaller. And by adding to those winners, we get a few big wins during the year. 80% of our money comes from just 20% of our trades. It's just how it is. Okay, and we expect to be a bit better than a 50-50 coin, not right 100% of the time. We just don't have a time machine or a crystal ball to be able to do that. VSL, volatility-based stop losses. The more volatile the market, further away the stop loss. Private investors don't do that. VPS, volatility-based position sizing. Further away the stop loss, because the market is more volatile, smaller the position size. Again, retail clients don't do that. So what do retail clients do? They take massive bets, add to their losing positions, and then even if they call it right as we do, fine. When they call it wrong, as they're bound to, as we are as well, they really lose their shirt. When we get it wrong, we don't. Remember, we had a small position. We narrowed it when the markets were more volatile and more likely to go against us. We added to our winners when the times were good. So we, by making a few changes, just do a hell of a lot better than retail clients. So let's look at a typical fund which people think does incredibly well and show you some of the problems. This is their performance. Now, I'm speaking to you at the end of December. So they've put their year-to-date performance to the end of November. They're up 8.5%. Their equities are up 12.1% and so forth. Now, here's several problems already. First of all, the Nasdaq is up 55%. The S&P 500 is up 25%, which means their equities have done half as well as the S&P 500. But there's a bigger problem. Overall, they've only done as quarter as well as the S&P 500, let alone the Nasdaq being up 55%. And the reason that 33% of their performance is shaved off from equities to what they've actually done is because they've got bonds and cash. And you might think, well, bonds and cash, nothing wrong with it. And of course, there isn't. So why have they underperformed so poorly? Well, one of the reasons is, and you can see their top 10 holdings at any given time. Let's take Meta. Up 250%. And you might say, well, they can't put all their money in just Meta. No, they've sprayed and prayed a bit. But there's another problem. Last year, Meta was down 80%. And a company like this, a fund like this, will have suffered huge losses last year. And whilst they made some gains this year, they didn't make the 250% type gains because they would have got into Meta probably too late and too little. So what's the better approach? The better approach, of course, I'm going to advocate is you do it yourself. If you're monitoring once a fortnight for about 10 minutes your pension, making sure none of the stocks you pick falls more than 25% of the high since you've bought it, and only selecting those which tick the value, growth, income, cash flow, Sortino and alpha boxes, then for the sake of 10 minutes every fortnight, you can definitely do better than these funds. Sorry. I've received yet another typically really bad portfolio to analyze for someone. Let's just dive deep into it. Now, this is typical of the kinds of portfolios I'll receive, and it's not the fault of the individual. This is for their pension, and several mistakes come to mind here and why their pension will be underperforming. Now, first things first, they've clearly gone for a whole bunch of name recognition companies. These are names that are on the high street that they'll have heard of. Now, nothing in and of itself necessarily wrong with that. What concerns me about this is that, okay, so they've got 12 stocks. Again, in and of itself, nothing necessarily wrong with that because they've got a bunch of funds, and we'll deal with the funds later. What worries me about the individual stocks that they've got is that they're just not ticking enough boxes, and there's so much more they could have chosen from. When I'm selecting stocks, we go through a portfolio of 10,000 companies. That could be in my SIP or ISA or junior ISA. And then analyzing those 10,000 for their valuation, we need the valuation box ticked. Are those companies undervalued? Are they growing in revenue and earnings? None of this guarantees the stock price will move, but we know from Nobel Prize winning academic research that actually that leads to a higher probability that the stock price will rise than if it was overvalued and was growing poorly. There are exceptions to the rule. Nothing is guaranteed. However, we're playing the odds. So we want to tick valuation, we want revenue growth, we want dividend yields. We want to look at the company's cash flow and look at cash return on capital invested. Now, if you've got $50 million, Goldman Sachs will do that for you, but this is the formula they use, CROCI, cash return on capital invested. And you want the company to be in the top quartile because those are the companies which as a basket generate 30% per annum. Not every year, not guaranteed, but as a basket on average over the long term, that's what they generate. Now, very few in this individual's portfolio tick that box as well. We need all 5 boxes ticked: value, growth, income, cash flow, recent momentum. It has a low weighting for us, low importance, but it is important. Okay, Sortino, the average return versus the risk of missing it. Why take lots of risk if you're not going to get the return? And outperformance of the market. There are other factors you could look at. You might just gamble on a sector. We don't do that. You might just gamble on what's on the news or a name that you've come across. We don't do that. Obviously, for obvious reasons, that'd be just too ridiculously, well, gambly. So not enough ticking our boxes. Basically, there are many more stocks which would do better for the risk you're taking, the volatility you've got. So to exemplify that, over the last 6 months, the stocks in this portfolio have generated a negative 3% return. Now, that just exemplifies the problem I'm stating, even though one company was up 41%. Because, as I speak, the broader NASDAQ index is up far significantly more than that. You might say, well, yes, but what about the currency risk, Alpesh? Well, -3 versus being up, what, 30%? Even if you just track the index, let alone if you try to cherry pick a few stocks from the index using this approach. And if you don't want to cherry pick, then you just track the index. You guys, well, it might be just a small time period. It might be just a one-off. Yes, it might be. My problem, as I say, with this is it usually isn't. It's usually that people have just picked without knowing what on earth they are doing. And for how long should they hold? Well, this is the flowchart I recommend they use. 12 months and then review. And you might hold again for another 12 months if they tick all the boxes, or if it's dropped, as a rough rule, 25% from the peak since you bought it, but you can always change that to, if it's dropped 10%, you'll sell half, and another 10%, you'll sell half. But some kind of stop loss mechanism and some kind of time limit, okay? And you can always review. You might end up holding the same stock for 30 years, but on the whole, you're going to underperform if you do it this way. Now, let's now look at the various funds. Now, the problem with the funds is this. Again, normally people will pick funds based on the emails they receive. So Bailey Gifford must do a lot of emailing to this individual concerned. And each of those funds will have 50 to 100 stocks. So if you wanted to have a bit more Microsoft or a bit more Costco, well, you've got a problem because you're probably owning through that about 500 stocks. And that means you're probably going to have 0.1% of, say, a Microsoft or a Costco or whatever else. So again, it's a typical common problem. Now, what I say about this is, look, the guy's obviously not going to go bankrupt. He's not going to lose all his money. But if that's the low bar you've set yourself, then you're going to have a pretty mediocre retirement. Because should you have, let's say you just did nothing better than track the NASDAQ, as an example, or even the S&P. Well, could you have between 20 to a 40% return this year, which is not typical? It's unusual, I grant you. Yes. Well, for a portfolio like this, it'll probably take 10 years to get the same return as the rest of us got in 6-7 months. Now, this year wasn't typical. But as I say, these are the problems that people often face with their portfolios. And it's what worries me about when they're looking at their pensions, when they're picking pensions, and the name recognition, the narrow group of stocks, which are pretty poor, or spraying and praying based on, well, emerging market sounds good, American sounds good, to a narrow group of fund managers who themselves are underperforming the market, as you can see. I mean, the data speaks for itself. So that's pretty shocking, because we've now had 2021 and 2023, which have been exceptionally good years for the market and people's pensions, where some have doubled their money. This individual will not be part of that. And this individual represents about 99% of the portfolios that I see coming in to me. Sorry. Thank you very much. Knowing what kind of investor you are is incredibly important to managing your pension and getting a good pension return. There are 4 types of investors, and you often don't know which category you're in. So it's important to work that out. My job is to help you work that out. And then once you've worked it out, you can have the right kind of investments to suit you and get the growth you've not been getting through an IFA or a wealth manager, because they don't go through this process. They lumber everybody into one group. So the first type is the worrier. The worrier feels that holding stocks for 12 months is way too long because they're worried. They don't like the drops holding a single stock in a portfolio can involve, because a single stock could drop, for instance, 35%. And that's not bad that they don't like that. Nobody likes that, but it really particularly would bother them. They like to monitor a lot and regularly because they're a worrier, and that's fine. We've got to deal with the personality you are. So with this first type of investor looking at their pension, the solution is they should have all of their investments, let's say, in exchange-traded funds. These are index trackers. They're baskets of stocks. They could have as many as 500 stocks in them, like the S&P 500, or even more, like a world index tracker. Or they could be thematic, like AI, or they could be style-based, growth, and so on. The characteristic of them, though, when we go through them, is we look for the ones which have a projection of 40% on existing trends, which have continued momentum in that direction, high Sortino, in other words, high average returns, low downside risk. So that they tick a lot of our boxes, and low volatility, preferably below 10%, maybe even below 8%. Okay, so that gives us high consistent returns with downside volatility. That way, they've got smoother trends and fewer sharp falls than individual stocks. And for the worrier, this is particularly attractive. And you might say, hell, why doesn't everybody do that? Well, they're welcome to. You might decide that you're one category and you want to move to another. Let's look at the next one, the constant observer. The constant observer likes to watch their pension very regularly. So in some ways, similar to the worrier. They're not likely to wait 12 months to see how performance goes. Again, similar to the worrier. They expect after 3 months to see an excellent result, maybe even after 8 months, excellent result, and they're easily disappointed. Okay, so again, not anything necessarily wrong with any of these. Now, the solution for them, because unlike the worrier who tends to be more risk averse, these guys are partly risk averse and also they want those returns. So what might be suited to them is both the ETF side, where you're looking at the 40% lower downside volatility, but equally our intermediate term tactical stocks. These are the ones where we're looking for 40% returns, but in a sooner period than 12 months, so maybe in 6 months. They might like our non-special situations, which are the ones where they're very much particularly based on momentum and don't tick all the boxes of a value, growth, income, and so on. And the constant observer, because they're constantly observing, they don't mind that so much. They can take more of the volatility compared to a worrier. Not too much more, but a bit more. That's why they have some of the ETFs. So they have that. Now you've got the mixed user. The mixed user, like some of the buy and forget for 12 months portfolio, they're fine with that. Okay, they want some extra zip too as part of their funds, and they're willing to spend a bit of time on that. Okay, now the solution for them is, again, the intermediate term tactical stocks, the hedge fund and banking non-special situations. They're going to have the special situations as well, the ETFs, and the regular Great Investments Program further filtered Quality 5 Plus. Okay, and why? Well, because the zip comes from the hedge fund, the non-special situations, the intermediate term. They might even do some of our leverage ones. And then the core, I'm happy with the buy and hold, comes from the Great Investments Program. The relaxed investor, the final one, they're happy to wait 12 months. They know the 25% exit. They want simplicity. This is me, by the way. Solution for them is Great Investments Program, further filtered, Quality 5 Plus, including ETFs. Sometimes I add a bit of leverage because I'm a bit of a mixed user now and again. But I'm one of those two categories. There's not a right category. For whatever category you are, we've got to find how do we get to that return. Now, if you get in the wrong category and you pick the ones which you're supposed to hold for 12 months, be relaxed with any drops, all the rest of it, but you're actually a worrier or a constant observer, you're going to end up getting emotionally distraught. You're going to end up prematurely exiting and then realizing, oh, actually, I should have held on anyway. You're going to get confused because you don't realize that it's about the whole portfolio, not every single individual stock, but the whole collective to deliver the returns. So that's a manner in which we very quickly try and identify. I say very quickly, it can sometimes take the individual several months to work out who they truly are, because what people say they are and what they actually are, as we all know, two different things. Anyway, have a look at the links in the bio, like and follow for more, and look forward to speaking to you soon. Thank you. If your pension's underperforming, you would probably want a load of free resources. I suggest you head on over to campaignforamillion.com, which I established after years of experience working with investors. It's completely free. We've got a ton of resources there. It is my campaign to teach 1 million people how to add an extra million to their pensions across their lifetimes. Now, campaignforamillion.com is where you would go. It includes all that I've learned from my 200 columns in the Financial Times, my Bloomberg TV shows, my 18 odd books as a hedge fund manager as well. The reason why your IFAs, wealth managers, are underperforming in your pension, why your pension isn't growing and what to do about it. It is as much for beginners as it is for seasoned people who want to professionalize things. So head on over to the website, and you can also get a free pension review through there as well. Get in touch with us, and my team and I will cast our eyes over your pension, give you a detailed analysis, and have a call with you, all free as well. Okay, so see you soon.